With all the AI hype, with plenty of AI companies that have already gone up throughout the last couple of months, it is quite difficult to find, let's say, the diamond in the rough. But this company, a company you're very, very familiar with, in my opinion, might be one of those opportunities. It's a company that year to date hasn't really moved that much, and yet the business has always proved itself to be growing in a profitable way, although quite not as profitable as it could be, but the underlying business is showing some promises. Plus, it's a company that is, let's say, pretty dominant in what it does, despite it being quite a small company compared to the likes of Amazon, Microsoft, Google, etc., etc. That company is, of course, UiPath. You know UiPath because we've talked about that company for quite a while. At the first, I have to admit, I was a bit skeptical. I thought they had no moat. I thought big tech companies would destroy them just like that. But the more I look at the numbers, the more I look at their performance, the more I'm convinced that maybe they do have a chance. It's not in my personal portfolio right now. I'm following this company. We're going to cover their earnings report, which I think come out in a month or so. But I do see them evolving. I do see them taking this opportunity to actually have a competitive advantage. Why is that? Well, first of all, let's maybe talk about what UiPath is. To explain that, of course, you need to know what robotic process automation means, or RPA, because this is something that if you look inside the company, you're going to see that word quite a lot, or inside the reports. So RPA uses software robots called bots to automate repetitive tasks on your computer. These tasks are usually rule-based, meaning they follow a clear set of instructions. RPA bots are good at following instructions and working quickly without mistakes. This frees you up to focus on more creative, complex work that requires human judgment. So you might already say, with the rise of LLMs, ChatGPT, stuff like that, isn't this going to hurt their own business? Well, first of all, they also launched their own LLMs. And like it says here, an LLM can make a lot of mistakes because it has to think for itself or think for itself by using data that might be flawed. Here, like it said, the tasks are usually rule-based, meaning they follow a clear set of instructions. They can work quickly without mistakes. Very, very important because you're using this software because you do not want to lose time on repetitive tasks. So, think of all those boring repetitive tasks you do on your computer every day. RPA can take care of those, giving you back your time and reducing errors and, of course, costs as well. If we look at the projections for RPA's market size from 2023 to 2033, it will grow at a CAGR of 25.7%, reaching $178.55 billion. And of course, UiPath currently being only a company at the size of $11 billion, you can say that there is quite some upside. More specifically, right now, of course, this can be wrong. These are just 12 months outlook estimates. The average price target from the 22 analysts covering this company sits at $27.89, representing around 43.2% upside. Now, of course, if they succeed, if they continue to grow and grow in a profitable way, seeing how big that market will become, you can rest assured that your investment will probably be a very successful one. Now, that's a big if because execution here is key. More on that in just a second. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. Tonight, actually, we're doing a Giga live stream where we cover Palantir's earnings report. If you're interested in that, go hit notify me on that live stream. It's already scheduled on the channel. If you enjoy this type of videos, like I said, hit that subscribe button. It's free. We're very, very close to reaching 40,000 subscribers. So thank you very much for all the support. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's continue here a little bit with regards to some valuation metrics, and then especially when it comes to SBC as a percentage of revenue, because we know unprofitable companies that are still expected to grow quite fast, top and bottom line, as you can see here. Analyst estimates for fiscal year 25, 26, 27, when it comes to sales year-over-year growth, you get an average of 16, 17% or so each and every year. With regards to EPS, fiscal year 2025 is going to be a year where they only grow 6.96%. Then in fiscal year 2026, another 18% year-over-year. And then in 2027, another 23% year over year. So currently forward PE of 33.7 times, EV to sales in the next 12 months, 6 times. So yes, you can say it's not the cheapest out there, but if they succeed, I do expect them to grow a bit faster than those estimates right here. Currently, with regards to their next earnings report, the revenue estimates of $333.01 million, EPS GAAP estimate, a loss here of 4 cents, non-GAAP 12 cents. But if you look at SBC as a percentage of revenue in the last 12 months, sits at 28.44%. While it is still high-ish, you would like it to stay at around 20%, maybe a bit less, if they can succeed in growing much faster, but you can clearly see that it has been improving for the last couple of quarters. Then we recently had some announcements which should help them grow their business a bit faster, because now UiPath AI cloud software receives approval for US government use. So with UiPath's leading business automation platform, public sector agencies can put intelligence to work to streamline processes, eliminate errors, and deliver better experiences to government employees and citizens. It was authorized through the Federal Risk and Authorization Management Program. You might know this as FedRAMP, which was established in 2011 to provide a cost-effective risk-based approach for the adoption and use of cloud services by the federal government. UiPath's Automation Cloud public sector is available through FedRAMP Marketplace. Now that the government or parts of the government could be their clients, I do expect revenue growth to accelerate. We have a new price target here from an analyst at KeyBank, price target at $27 with an overweight rating. So the analyst here says, with improved execution and an uptick in expansion platform adoption activity in recent quarters, we believe the go-to-market and leadership changes over the last 2 years are beginning to bear fruit, which could translate to potential ARR growth upside of over 20% in fiscal year 2025 and 2026. UiPath continue to add new products to its portfolio, such as task mining, communication mining, and document understanding, which, of course, their LLM is helping them with that. Also, as more companies integrate generative AI into their businesses, it should help, as UiPath has leveraged AI in its products for years. And then, with regards to competition, despite UiPath facing competitive pressures from other horizontal software vendors such as Microsoft and Salesforce, UiPath continues to be the dominant player in the automation space, holding 36% market share. So yeah, despite being a small company, I think they're doing quite well. And of course, the more clients they attract, the more they get integrated in plenty of businesses, the more difficult it will be for those businesses to actually switch products. And that's going to be the moat. You do not, as a business, want to integrate many products, something that helps you out as a business, right? Because here it's about saving you money and time, automating a lot of boring tasks. If it works out, why would you switch? Why would you go through all the trouble to switch all of the products and services that you have adopted in the last couple of years for something else? Just doesn't make sense. Plus, if it is one of the best products out there, why would you switch? Now, looking at the past quarter and fiscal year 2024, revenue grew 31% year over year in Q4, and for the full year, 24%. With regards to ARR growth, that was 22% year over year. Now, the problem here is, and one of the main reasons why the stock has been dropping for quite a while, is because ARR growth year over year has been slowing down. And as you will see in just a bit for the next year guidance, it might not stop there. It is stabilizing a little bit, but you would like to see this going up. With regards to GAAP operating income for Q4 was actually not a loss, $15 million with a GAAP operating margin of 4%, but for the full year, still a loss, GAAP operating margin negative 13%. Non-GAAP operating income of $111 million or 27% non-GAAP operating margin for Q4. For full year 2024, 18% non-GAAP operating margin. If we look at ARR growth, yes, it's true. The CAGR here is 32% since Q2 2022, so that's great, but you can clearly see that year-over-year growth is slowing down. Dollar-based net retention rate 119%, which still is quite good, but that also has come down. If we look at guidance for Q1, yes, revenue is down quarter over quarter. Q4, usually a stronger quarter. This time, they expect it to come between $330 and $335 million. With regards to ARR, $1.51 billion, non-GAAP operating income of around $55 million. Then, when you look at fiscal year 2025, revenue to grow around 19% year over year. And here you can clearly see ARR only 18% year over year, which, as we've seen a minute or two ago, it is lower than full year 2024. Non-GAAP operating income should more than double, almost triple, at around $295 million. Now, in my opinion, they should be able to beat those growth numbers. Now, if we look at the stock right now, if we look at the graph, we can clearly see that the stock has been making higher lows, actually all the way since October 2022, so that's fine. If we look at the last couple of weeks here, we can say that around $18 or so, it has found some support. It was previously quite a big resistance point throughout, well, the last year and a half or so. Then, of course, back in late 2023, we had that huge jump over $25. We couldn't really stay above that. Then we went all the way back down under the 50, the 20, and the 200-day moving average. If you're interested, the 200-day moving average sits at around $20.62, 51 at $21.48, and the 21 at $20.27. RSI right now, neutral. We don't really have that much momentum with regards to that stock, which, of course, if you're a long-term investor, could play as your advantage. When nobody is looking at a business, when nobody is looking at a stock, that's usually when you have that advantage. Now, of course, everything we've seen now in this video is from past quarter. You want to see continued growth, continued execution. But right now, I mean, is it worth the bet? Probably. If you're holding this company, do let me know down in the comment section below. Have you been adding, selling, or just holding? Let me know down in the comment section below. I was previously quite skeptical about this company. I'm becoming a bit more bullish on what UiPath is trying to do. But of course, I might be completely wrong. Do let me know what you think about this company down in the comment section below. And I see you all in the next one. Bye-bye.